Welcome to the weekly update, where we'll go over the action in the market for August 8th through the 12th, and then see how things look for August 15th through the 19th. And we had yet another up week. So things are still looking a little bit more positive. We're positive on the daily charts, but we're a bit overextended. Some of our short-term indicators are giving us extreme positive readings. Even a few of our intermediate term indicators are also showing us that they're a little overextended right now, but the weekly charts are still showing us a lot of improvement in the market. So let's go back and talk about the week's session. The CPI came out. That was the biggie. That was on Wednesday, and that's what the markets have really been anticipating. Then on Thursday, we had the PPI, or Producer and Price Index, and that ended up being market friendly as well, although not quite as much. At least the market didn't take it that way. And then in import export, the price index came out, and this helped to see the advances that we saw for the week. And it also is supporting this narrative right now that maybe inflation has topped out and it's starting to come back down. Now, that's what the markets are trying to anticipate right now. Please be reminded that not too long ago, we had this same scenario develop and then it got blown out of the water. But we are seeing a consistent lessening of inflation for right now. The problem that we're having is the employment situation is still very positive. And typically when you go into a recession, when you see a slowdown in the economy, the employment situation tends to get worse. Well, it's still really hanging in there right now. All right, the gains, they were broad-based. All of the sectors ended up being positive for the week. So they were broad and substantive. Okay, I'm not going to re-record this. Then we had the fourth straight weekly advance, and we also got up to 42.31. This is where some people go from the high set back in January to the low that was set in June. And then getting back above that level, that's a 50% retracement. And when we break above that, things are seen as much more positive. Then they also think that maybe the low that we set in June was the actual low. Wednesday and Friday ended up being the strongest days. And then talking about CPI again, it was unchanged on a month-over-month basis. Of course, then we had the president come out and say there's no inflation. Well, what he was talking about is there was no month-over-month change. Yes, there is still inflation. Yes, if you live life every day, you're probably seeing inflation every time you fill up your car with gas or you buy food or pretty much anything right now. And then the core CPI, which excludes, it takes out food and energy, it was up smaller than expected. So both of these reports weren't as bad as what the market had been fearing. And then total CPI, which now you're looking at it on an annual basis, it slowed down to about 8.5% on an annual basis from where it was a month ago at 9.1%. Where the core, you take out food and energy, it's the same. It's about 5.9. Still very, very high, still higher than what we've seen in decades, but it is starting to come down and the market is taking that as positive. Volume still remains below average. Even on up days, down days, we might get a good volume day here and there, but overall volume is still pretty anemic, below average. And the S&P, again, has retraced 50% of the losses from, and they measure it from January 3rd, the closing level. I measure it from January 4th, the intraday high level, going back to the June 16th closing of 3666. Ooh, the close of the beast, 0.77. Anyway, we're back about 50% from that, and all 11 sectors closed higher on the week. All right, so we were up 3.26%. Volume was below average. The technicals are still kind of negative, but they're showing a lot of improvement, and I'll go through the charts. The markets are still really fixated on inflation and interest rates, and then we have a whole additional list of things that could come to the forefront at any time. Our trend is starting to come down, and the ADX chart that I'll show you is looking a little interesting right now. It's still in a negative trend, but the negative is really coming down. The positive is coming up, and they could cross in the near future if we continue to see what we've been seeing. Here is the intraday 10-minute chart. Each one of these bars is 10 minutes. Going back to Monday, a little bit lower, not much happened. Tuesday, this was pretty slow ahead of the CPI coming out on Wednesday. That report came out and boom, we ended up shooting higher. In fact, we shot so much higher, I had to add R3 and R4 onto the chart, which usually you don't see very often. That's because the daily ranges were so small that we really shot up. So Wednesday saw a good day. Thursday, we went up only to come kind of back down. But then Friday ended up gapping to the upside and then closing right at the high. So most of the gains that we saw were back here on Wednesday and then on Friday. The Dow was up 2.9% on the week, the NASDAQ 3.1%. The S&P, I have it a little bit different, but here it says 3.3%. And the Russell, this is encouraging. These are the small caps, and they were up 5%. If we're going to see the large cap, which is the S&P 500, really start to advance, it's good to see the small caps advancing too, because they're considered to be riskier stocks. And if people are willing to venture into those, that could really give some support to the market. Here is for the last week where we had the mid caps were up the most, followed by the S&P, and all of the other indexes ended up being positive on the week. This is going back to the high that I look at from January 4th, showing how the Dow, the mid caps, the NYSE, the small caps, the pink one is the S&P 500, NASDAQ, and then NASDAQ 100, how they've performed since that time. Our sectors were all positive on the week, with energy being up the most. The financial sectors had a good week. Materials, all of these were positive. The one that was the weakest, it was still positive, but staples performed the least best, if that makes any sense. They were still positive, but not by as much. This chart just shows a measurement of how things did over the last 5 trading days. Energy has been recouping a bit, and all the other sectors ended up being positive. Now, this is measured from Monday to Friday instead of some other measurements which go from Friday to Friday that way. All right, current market valuation starting to look a little toppy here, even though they're still saying that we're fairly valued. I have a little bit different look at this. This is the aggregate. This is taking all the different charts together. It's showing that we're above this dashed line and we're not up to the yellow dashed line. When we start to get above that, that means that we're overvalued. As long as we're between the yellow line and the green line, that is considered fairly valued. But looking at some of our charts, the yield curve, it's considered to be overvalued. It's really been popping up lately. Then looking at the Buffett indicator, comparing stocks with GDP, it's still above this yellow dashed line. So that's also overvalued. The PE model that they use is also above this yellow dashed line. So that is overvalued. The interest rate model, because interest rates are still historically low, we're not up to this yellow line. So that is considered to be fairly valued. And when you look at margin debt, you have a lot of folks that are just not using borrowed money right now to buy stocks. That has actually gone down to being undervalued. And when you take all of those together, they come up with a fairly valued score. Then the mean reversion model, where we're just slightly above the yellow line so that we're slightly overvalued. All right, let's go back and look at sentiment. As of the close on Friday, we were at 55, just a little bit to the right of neutral. And here's the historical average. When we get down in here, we were below 25 for a long time. We were showing extreme fear. And when we start to take notice is when we get back above 75. Well, as this is going up, we can jump on and ride that. We don't always use sentiment as a contrary indicator. When we use that is at extremes. When everybody is really greedy, we're looking to get out. When everybody's really fearful, we're looking to get in. That's how we use that in a contrary manner. Also, on Friday, we had the consumer sentiment report come out. That added some support to the market because even though we had a reading of 55.1, which is still very bad, at least it bounced up from the reading before. So that's showing that people are seeing a little bit more hope now. But there's still a really wide range between the 2-year treasury yield and how people are feeling. And we would like to see this come down. Either people start to get happier or interest rates start to come down. But to have them this far apart is not necessarily normal. All right, now we have some Isabel net charts. These are cyclicals, things that cycle with the economy, against defensive, the ones that tend to do better when the market's having trouble. These are rotations showing the pricing that they're putting into this is suggesting that there's going to be a slowdown. Because when we do a ratio between the two, we're seeing this dark blue line here. It's really starting to go down. And that's pretty much matching what we're seeing in the ISM manufacturing index. It's also suggesting weakness. So this is playing into the scenario that the economy could be getting weaker. Also, we have GDP growth. This is what Goldman Sachs thinks is going to happen. Over here on the left-hand side, these are the quarters. First quarter, second quarter. That's what we just finished. And we were down 0.9. Well, for the third quarter, which is what we're in right now, they think we're going to be up 0.9. And then the fourth quarter, 1, and then carried over into 2023. Over here on the right-hand side, we have, this is what they think the annual GDP will be for 2022, 2023, and 2024. Now, this could change, and this is just a forecast, and we don't know how right on this is, but people like to look at these things just to get an idea of what these companies are thinking or what they're forecasting. This kind of goes hand in hand with the American Association of Individual Investors. They had been really extreme negative, and that is showing that sentiment is very fearful. That can be a contrary indicator, and they're just showing other times when we were down at this level before, things tended to perform quite well after that. This is showing the PE 10 valuations. This goes more hand in hand with the Shiller price or PE ratio, where it's been coming down as the S&P has been coming down, but it's still kind of showing that we're overvalued. We're the median price for 46 different countries. That's the blue line here, where we have the US or the S&P 500 is probably what they're using here, where we tend to be a lot more overvalued when you compare it to other countries. The insider transaction ratio is still in bullish territory. It will stay bullish as long as we're underneath this black line. Also, this is looking at inflation in Germany. Yeah, they're having very high inflation there too. And they're predicting that the recession is going to go on a lot longer. Now, sometimes, whether it's culturally, economically, through fashion, and sometimes, believe it or not, even in tech, Europe tends to precede the US. And if they're having a lot of trouble economically in Europe, do you think that might mean that that could come over into the US and that things are not necessarily improving as fast as a lot of folks think they are? Pure speculation at this point, just something to be aware of. Also, we have a thing called TIPS. These are inflation protected bonds that you can get into. They actually adjust their rate based on what's going on with inflation, but it's seeing that people are starting to get out of these. This light blue area is the flow, and the dark blue is the 4-week average of the flow. Money has been coming out of that. So that means that people that get into these, they're like, wait a minute, why do I want to get in an inflation-based bond when I'm not really worried about inflation and I can get a higher return by going into a treasury bond? That's kind of the thinking that's going back and forth. In a low inflationary environment, these are not good investments. In a high inflationary environment, these are good investments. So this is kind of going a little bit counterintuitive to how some people are thinking right now. We had the latest reading of the RIDEX bear bull ratio showing that we're kind of in between right now. A lot of the folks that use these mutual funds, they're about split, whether they're in the bearish mutual funds or the bullish mutual funds. Here's the AAII summary that I talked about a little earlier, where we had been extreme positive, but we're starting to come up out of that. The VIX is starting to decline and actually going below 20. This means that fear is really subsiding right now. The Ulcer Index, and I've been showing this in all of my daily videos. This shows that fear has been coming down, but this just about lines up with what we're seeing with sentiment right now. Copper, after really starting to fall, has been bouncing back a little bit. So that might suggest they're seeing an economic improvement. Now, some of these daily scenarios, these are just things that I bring up in all my videos. I want to mention them because if you're into the S&P 500, if you really follow the indexes, we're seeing some positive setups right now. And so I just want to make sure that you get exposed to this information. This is just showing the percent of stocks above their 200-day simple moving average. We had gone extreme negative and now we're bouncing up. And this is a daily chart. Also, the stocks that are above their 50-period moving average, where it had gone extreme negative and then boom, we're starting to show extreme positive now. That could be short-term kind of negative because we're going up a little too far too fast. But to see it go from negative to extreme positive overall, that could produce some support for the S&P. We're also seeing a real improvement with the mid caps and with the small caps. So we're seeing it across many indexes. Here's the 5-period simple moving average of the equity put call ratio. It's spiked up and has been coming down. That sometimes gives us a nice positive setup. Here is our sector rotation. The Qs, they still are outperforming the SPY, the discretionary, as well as large cap growth and value. They're also outperforming, even though it's slowed down just a little bit last week. Here's the large, mid, and small caps looking at the growth and value, where they continue to advance and the moving averages are still going higher. We're seeing the mid caps showing a little bit of weakness. We dropped slightly below the moving average here. So we'll want to keep an eye on this. Here's the small cap to large cap ratio. And it shows that small caps have gone up a little bit and they're slightly outperforming. They had a good week last week. Here is another look at that same chart. Here's the red. This is the ratio. And when we see this going up, that means that small caps are doing quite well. And a lot of times this lends support to the blue, which is the S&P 500. This is a 10-day average of the highs and lows. And we had gone extreme negative, and now we're bouncing back up positive. That's another positive setup. This is a big picture look, taking the American Stock Exchange, the NASDAQ, and the New York Stock Exchange, taking a 5-period simple moving average of the highs to lows, where we had gone extreme negative, and now we're starting to bounce back up. This one isn't as strong. This is the 2-year yield spike. And when it spikes up and starts to come back down, a lot of times that can be a pretty positive signal. But we're really close to that. If 2-year yields continue to go up, we're going to take out this spike. So this one isn't as positive. The staples, even though they're in a negative trend, they've been going back above both of the moving averages. But to me, this is the strongest one, where we spiked with the staples to S&P 500 ratio. We fell down, and this is continuing to fall. And this really often marks a low in the S&P 500, if this can stay doing what it's been doing. All right, looking at the Shiller PE ratio, it still shows that we are very overvalued. The median and the mean are between 16 and 17, where we're double that right now at 32. So looking back, and taking inflation into account, this is suggesting that the S&P 500 continues to be overvalued. All right, then we have some fact set articles. This says when you take out energy, the S&P 500, okay, I'm having a little, I have to go back. The S&P 500 is reporting a year-over-year decline in the earnings of 4%. So this is what it was overall. It was up 6.7%. If you take out energy, boom, it's down 3.7%. Then for the current year, it had been at 8.9%. You take out energy and boom, it's down to 2.4%. So energy has been a lot of the gains for 2022. This is also saying that the market is not punishing those negative earnings surprises as they're being reported. And as this was being written last week, 87% of the companies have reported, 75 have been above their estimate. And then in the aggregate, earnings have exceeded estimates by 3.4%, and they throw this all around and they give you the average. Feel free to pause this and just look this over. And are they rewarding positive earnings surprises? Those companies that have them, they see larger price increases than average. So yeah, if they blow out and come in ahead of their estimates, you'll usually see the prices go up. This is kind of a convoluted chart here, where these blue bars right here, this is a number of companies that are reporting a surprise percent in each range, whether this is just a number of companies. And then over here, it's the average price change percentage 2 days before and 2 days after the report. So again, if you want to pause this and look at it, maybe you can glean something useful from this chart. This, I don't think, is all that useful. It's just showing how Morgan Stanley's earnings estimates compare to the consensus for 2022, and now they're starting to project out into 2023. All right, this is kind of interesting too. This is the chart from a week ago. On August 5th, they were saying there's a 68% chance that at the next Fed meeting, there's going to be 0.75% rate hike. Well, project this ahead a week. This is as of Friday's reading. This has now dropped down to 45%. And this is going to gyrate all over the place. And as we get closer to the actual meeting, still a ways off. It's not until the 21st of September. We'll keep watching this and get more in tune with what's going on. So this can adjust and change quickly right now. We're also showing where the Fed balance sheet continues to decline. Looking at breadth, we saw a real nice spike up based on price and volume. So that's showing a lot of improvement. And we've seen a couple of weeks now of real strong volume overall. So this is helping this technical picture. The advanced decline ratio also is looking positive. New highs, new lows continue to advance. Accumulation distribution looking a lot better. So on a breadth basis, we're seeing a lot of improvement. All right, let's look at our trend. This is what I'm talking about with the ADX. The trend is weakening, but see how the red line's coming down and the green line's coming up? It may not take very long for them to cross. And if we do, and this is above 20, this could actually turn around and start to go back up if it turns into a strong trend. Here we have the Arun showing that selling has really been tapering off, but it's also suggesting that buying has tapered off as well. So the oscillator is flat for the week, and it's negative because it's below zero. The mass index, we're still working off of that signal that was generated just about the time we hit the low in the S&P, and we've been going up ever since then. Some long-term charts. The decision point charts now have their short and intermediate term models and signals. They're all positive, but long-term continues to be negative. Here's the chart, the weekly chart, just showing the price action with the pivot levels. We were able to get back above S1, but we still have the pivot above where we're at. That could be significant resistance. Also, we're still below the 50-period moving average on the weekly chart. That goes back a year. The trend is still negative, but showing improvement. And again, just like in last week's video, it's going to be a broken record on this. The BPI looking pretty positive, but possibly extreme. The Chaikin oscillator is also looking more positive. Chaikin money flow didn't really change all that much, but is slightly positive. The force index also advancing. The McClellan oscillator is advancing, looking a little extreme. The summation index is advancing based on price and volume. Our oscillators, if you use oscillators on weekly charts, I don't. Just look at the track record. Look at how these things were generating signals and look at what was happening with price action. And that pretty much makes the case right there. But we do have our oscillators turning up on the weekly chart. The Swinland trading oscillator, positive based on price and volume. Those PMOs that are rising continues to look positive, but maybe a little too positive. The buy signals also getting kind of extreme. The PMOs that are above zero also advancing and looking a little extreme. RSI, it's crossed above 50 and advancing, so that's positive. Here's the PMO study where it's turning back up and we're advancing based on price and volume. Special K still continues to be positive. Stochc RSI, extreme positive, as is the Williams percent R. The vortex, it just crossed over positive. Ultimate oscillator starting to get a little extreme, but it still could go higher than this. Money flow index also positive. Bollinger Bands positive. And really, this is the percent B. Where did this go here? Yeah, the percent B. This is based around the Bollinger Bands. KST is crossing over positive. Hasn't done that in quite a while. The PPO crossed over recently and is showing an uptrend. Rate of change is not necessarily extreme. Going back 50 weeks or 1 year, it's showing some improvement. The Copic curve is also giving us a signal when we bottomed here back in June, and we've been advancing ever since then. We're still above any kind of our Fibonacci support levels, but we're gonna run into some trouble if we get into this 40 period moving average right here. That could be some overhead resistance. We're also getting near some overhead resistance on the daily chart at the 200-day moving average. Our charts, Heiken Ashi, positive. Kagi, positive. Renko switched over to positive with an open block. Ease of movement, positive. The point and figure chart added 2 new X's this past week. That is positive. 3-line break, also positive. Our different trading systems. The Elder has remained positive, and we've been able to get above this moving average. Parabolic SAR, the dots are on the bottom. That is positive. Looking at the SPX, the mid caps and the small caps, they're pretty much confirming each other. We're not really seeing any real noticeable divergences, either positive or negative right now. All stocks still in a downtrend, but showing some improvement. Mid caps coming right up to the moving average, could act as resistance. Small caps also getting near the moving average and showing some improvement. The Dow, same thing. We're seeing a lot of this across the board right now. The NASDAQ still has a little bit more to go before it gets to this moving average, if it even gets there. But this has been really showing some improvement, as has the NASDAQ 100. The NYSE also looking a lot better, but still negative overall. The Wilshire also showing some improvement. The FANG stocks are showing some improvement. ARK showing some improvement. The biggest software companies, they're starting to show some improvement. These are the growth areas. Now, here is Dow theory, where we're seeing the Dow going up, the transports going up, and utilities going up. So we're not seeing really any divergences, either positive or negative. CRB index, it's still in an overall uptrend, but has really slowed down and in some cases actually declined. Gold had a pretty good week last week, but it's still in an overall downtrend, as has silver. It's still in that downtrend. Oil is at 92.09, so it's not as low as it had been, but it's well off the highs. Here's the weekly chart of the dollar. It is still in an overall uptrend, but it did have some weakness. And lately, what we've been seeing is as stocks have been going up, the dollar has been going down. Looking at bonds, could be showing some kind of a base here and then a bit of an improvement, but we're still in an overall downtrend. Here are the yields, where we have the 30, 10, 5, 2, and it just shows how they've been dancing around. This is a daily chart for this. All right, some relative studies where oil still has been holding up the best since the beginning of the year, followed by the dollar. Gold continues to be negative. Stocks are showing some improvement, but they're negative. Bonds are starting to turn up a little bit, but they're also negative. Here's the bond to stock ratio, which it looked like it had been breaking out, but now it's falling back below the moving averages. The stock to bond ratio on a monthly basis shows that stocks are back to outperforming bonds. Here's the gold to the US dollar ratio, with the dollar doing so well and gold not doing very well. Lately, we've seen this tick back up as gold has some strength, while the dollar has been showing a bit of weakness. Overall, here's the gold to the S&P, which gold had been doing quite well, but now is starting to break down. Here's the low volatility stocks to the S&P. They had been really underperforming in 2020 and 2021. They spiked up, but now they're starting to come back down. The growth versus value is showing some improvement here. The NASDAQ 100 to the S&P 500, also still in a downtrend, but showing some improvement. S&P 100 to the S&P 500, also still in an overall downtrend and not necessarily as strong as we would like to see this. Discretionary against staples in a downtrend, but has lately been showing a bit of a comeback. Energy to tech. Energy's been doing great. Well, now energy's been really falling back as tech has seen a little bit of love lately. So then what's our outlook then? The reports that are coming out on Tuesday, we have housing starts, building permits, industrial production, and capacity utilization. Those are the big reports that are coming out. Then on Wednesday, we have retail sales. That's a huge part of the economy. And we'll have the FOMC minutes that will be released right around 2 p.m. Eastern. On Thursday, we have existing home sales, jobless claims, and that's pretty much it. There's really nothing of significance coming out. I don't think there's anything coming out on Friday. The technicals, they're still kind of negative, but they're showing a lot of improvement. If you're a little more liberal with how you view things, you see this a little bit more positive. If you're a little bit more conservative, you might still want to wait for some more confirmation. The markets are still really fixated on inflation and interest rates. And then here's the list. I won't read this off to you. You can just pause and look at that. I cover these things, and if any one of these things comes to the forefront, I will cover them in the daily videos. So our scenarios, we can't really say that we're down, and this is based on the daily charts. Things are just looking pretty positive right now, where we are more in an uptrend, at least on the daily charts, because the technicals are positive. But as I stated earlier, they may be becoming overbought. There's still a real disbelief that the market will go higher, and then there's the fear of missing out, which may play into this at some point where people are like, wait a minute, we've already bounced 14% from the low in June. Oh my gosh, I'm not going to have any return at all. I better get in right now. And then sometimes that ends up being some kind of a top in the market. Our scenarios are still looking okay on the daily charts, but there's a little bit of divergences that we're seeing. The technicals are still holding up and positive overall, a little bit of a short-term overbought, intermediate term overbought situation, and we're not in a sideways movement right now, at least on the daily charts. So thank you. I hope you have a wonderful week. Please feel free to watch the daily videos, and then I'm also going to be posting the intermarket analysis video probably Sunday night or so.